Hello viewers, welcome to my channel. I'm Hashim Ali Khan. So this video is the continuation of the last video on theory of other receivables and payables. In the last video, I've explained you completely regarding what are the other receivables and payables. In this video, I'm going to explain you some more adjustment required while making the financial statements. So if you want to get a complete grasp on the topic of these other receivables or payables, first you watch the first video. Then only you come to this video. Otherwise, if you join in the middle, you may not be able to understand. So watch the video till the end because the theory is very important. The problems are based on this theory. So take a screenshot of the points which I have written on the board, so that you can make a permanent record of all the points, and before examination, if you review all these points, you can do excellently in examination. So take a screenshot, then I'll explain all the other adjustment required in making the financial statements. Come on, now I'm going to start few more adjustments. So further adjustment for making financial statements. For making financial statements, first of all, trial balance will be given and few adjustments are given. The students will commit the mistake while making the adjustment normally. So in this video, I'm going to explain you few important adjustments which frequently come across while making the financial statements. Financial statements consist of two parts. That is, first income statement and second part statement of financial position. The income statement is prepared to find out the profit or loss during the year, and statement of financial position is prepared to find out the assets and liabilities as on a particular date. Right? These two are called financial statements. Now, what are the adjustment? Very frequently, almost every problem will come across the adjustment called payment made in advance or prepaid, and it will be taken under other receivable. So remember, prepaid or payment made in advance. Example, insurance paid 10,000 rupees, that is $10,000, that is given in the trial balance. In adjustment, it is given prepaid insurance is 2,000. So out of 10,000 insurance paid during the year, 2,000 insurance is not relating to the current year. It is paid in advance for the next year. So how to adjust this 2,000? So here I have given the expression: deduct the prepaid amount from the total amount paid in income statement. First of all, in the income statement, total insurance paid given in the trial balance is 10,000 and prepaid insurance given in the adjustment is 2,000. So what is the first adjustment? Deduct 2,000 prepaid from the total insurance paid 10,000. So 10,000 total insurance paid minus 2,000 prepaid, 8,000 rupees insurance should be taken in income statement. That is the first adjustment. Second, the prepaid amount or prepayment should be shown as other receivables under current assets. $2,000 prepayment of insurance. That prepayment of insurance should be taken under other receivables under current assets. In the statement of financial position, under current assets, take other receivables. Under other receivables, you show that prepaid insurance of 2,000. That's it. This is one adjustment for prepaid or paid in advance. The second adjustment is amount owing or outstanding, accrued expenses, other payable. Very frequently, you will come across outstanding expenses or accrued expenses. Expenses of the current year but not yet paid. It is the expenses incurred during the current year but not paid during the year. That is called outstanding expenses or accrued expenses. Example, in the trial balance, salaries paid 1 lakh is given. In adjustment, salary is owing is given 20,000. So 1 lakh rupees salary already paid, it is given the trial balance. In adjustment, it is given 20,000 salary are still outstanding, owing. So what is the adjustment? This 20,000 still owing, that will be added to 1 lakh. The total salary will be 1,20,000. This 1,20,000 should be taken in income statement. Simple words. The owing salary 20,000 will be added to salary paid. And the total amount should be taken in income statement. First adjustment. Second adjustment. The amount to owing 20,000 salary, that 20,000 salary will be taken under other payable, under current liabilities. In the statement of financial position, we will have current liabilities. Under current liability, other payables. Under that other payables, we will take salary owing. That's it. So 2 adjustment I have explained. Third adjustment. Depreciation on non-current assets. Depreciation is the decrease in the value of assets due to wear and tear, lapse of time, obsolescence, etc. Number of causes are there. When we use fixed non-current assets, the value will get decreased, consumed. That value of non-current asset consumed is called depreciation. It will be given in adjustment. The 2 adjustments are there. Depreciation on non-current asset. Example, machinery. There is machinery non-current asset. $1 lakh is the cost of the machinery. In adjustment, it is given, provide depreciation on machinery at 10%. So 10% of 1 lakh is 10,000. So this 10,000 depreciation will be taken twice. Once depreciation should be taken under expenses in income statement. In income statement, we will have expenses part. In that expenses part, we take depreciation 10,000. One adjustment over. The second adjustment is this 10,000 depreciation will be deducted from the cost of the machinery. From the cost of the machinery in statement of financial position. In statement of financial position, we take non-current assets. Under non-current assets, we take machinery 1 lakh minus depreciation 10,000. The carrying value of machinery will be 90,000. That's it. This is regarding depreciation. The next adjustment is regarding irrecoverable debt. Already I have uploaded the videos for irrecoverable debt. Normally it is also called bad debts. The debt which is irrecoverable. A business will sell the goods to so many customers on credit. There is a possibility that some of the customer may not pay the amount. That's a loss. I'm having a business. I've sold to hundreds of customers. I've sold goods on credit. Later on, some of the customer have not paid me the amount. That is called irrecoverable debt. It's a loss. So if irrecoverable debt is given in the trial balance, 2 possibilities are there. Irrecoverable debt may be given in the trial balance or irrecoverable debt may be given in the adjustment. If the irrecoverable debt is given in the trial balance, it will appear only once. This irrecoverable debt will be taken under expenses in the income statement. That's it. Because irrecoverable debt is given in the trial balance. Sometimes irrecoverable debt is given in the adjustment. It will be taken twice. It will be taken twice. Once irrecoverable debt will be taken under expenses in income statement. Again, irrecoverable debt will be deducted from trade receivable under current assets. That's what I have explained here. If it is given in the adjustment, then it will come twice. That is, it should be taken under expenses in income statement, and again it should be deducted from trade receivable in under the current assets. That's it. So these are the 2 possibilities of irrecoverable debt. That's it. Now, allowance for irrecoverable debt. Irrecoverable debt is different from allowance for irrecoverable debt. Actually, irrecoverable debt is a loss, certain loss. Whereas, if there is uncertainty of loss, That is called allowance for irrecoverable debt. Simple words, expected loss is allowance. Allowance for irrecoverable debt. Actual loss is irrecoverable debt. Is irrecoverable. So normally, as a prudent accounting concept, a business will provide allowance for irrecoverable debt. If allowance for irrecoverable debt is to be created first time, last year there was no allowance for irrecoverable debt. Current year only we are creating allowance for irrecoverable debt. First time. In that case, what is the adjustment? What is the adjustment? So creating allowance for irrecoverable debt first time. It should be taken as expense in the income statement. First of all, the trade receivable is given in the trial balance as 1 lakh. 1 lakh is the trade receivable given in the trial balance. Adjustment it is given, create allowance for irrecoverable debt 10%. Create allowance for irrecoverable debt 10%, that is given in the adjustment. Now we are creating. So $1 lakh is the trade receivable. 10% of 1 lakh, 10,000 is the allowance for irrecoverable debt. So how to make this 10,000 adjustment? First of all, 10,000 allowance for irrecoverable debt should be taken under expenses in the income statement. Again, this $10,000 should be deducted from trade receivable. Under current assets. So in the statement of financial position, we will have current assets. Under current assets, we will have trade receivable. From trade receivable, deduct allowance for irrecoverable debt. $1 lakh is the trade receivable minus allowance for irrecoverable debt 10,000. So 90,000 is the net amount of trade receivable. That is creating allowance for irrecoverable debt. Next is increase in the allowance for irrecoverable debt. Sometimes already allowance for irrecoverable debt is there in the beginning of the year. In the beginning of the year, already one account is there, allowance for irrecoverable debt. So now we want to increase that allowance. By taking an example, I'll make you understand like this. If existing allowance for irrecoverable debt is given in the trial balance as $500, and in adjustment it is given as to be made up to 800. First of all, at the beginning of the year already there is an account, allowance for irrecoverable debt $500. Already it is there. So trial balance you can find an item, allowance for irrecoverable debt $500. Already trial balance we have. In adjustment it is saying that increase the allowance for irrecoverable debt to 800. The new allowance which is given in the adjustment is 800. Old allowance which is at the beginning of the year was $500. So how much is increased? 300. From 500 to 800. So $300 have been increased. Now how to adjust this $300? Here. This $300 should be taken under expenses in income statement. First adjustment. The increase in allowance 300. That 300 should be taken under expenses in the income statement. Now in the statement of financial position, the new allowance of $800 should be deducted from trade receivable under current assets. The new allowance, total new allowance is $800 given in the adjustment. So $800 should be deducted from trade receivable under current assets. Under current assets. So whatever is increase $300 that will be taken under expenses in income statement. New allowance 800 that should be deducted from trade receivable in the current asset. That's it. This is regarding increase in allowance for irrecoverable debt. Suppose there is decrease in allowance for irrecoverable debt, what is the adjustment? Now, if existing allowance of irrecoverable debt is given in the trial balance as $800 and in adjustment it is given as to be made up to 500, I have reversed the case. So in the trial balance it is already given allowance for irrecoverable debt $800 already existing, and in adjustment it is given that make the allowance for irrecoverable debt up to 500 only. The old allowance 800. The new allowance it is saying make it up to 500 only. So there is decrease in allowance of irrecoverable debt by 300. Now this decrease of 300 should be taken as other income. Should be taken as other income and added to gross profit in income statement. In income statement we calculate gross profit. To gross profit you add other incomes. In that other incomes we take decrease in allowance for irrecoverable debt. That's it. Now second adjustment is in the statement of financial position. Current assets. Under current assets take trade receivable. From trade receivable deduct the new allowance. The new allowance is $500. The new allowance is $500. This $500 will be deducted from trade receivable under current assets. That's it. The new allowance of $500 should be deducted from the trade receivable under current assets. That's all. This is the end of the theoretical part of the topic other receivables and other payables. So if you have watched with full concentration these two videos, theory videos, then definitely you don't find any difficulty in solving the problems on other receivables. So hope you follow my instructions. Inshallah, we will continue the problems on other receivables and other payables in the next video. So keep watching to get a complete command on the subject of accounting.